Hello and welcome to another episode of your Retirement Planning Simplified. I'm your host, Joe Curry, and back with me, my co-host, Lindsay Wilson. Lindsay, nice to have you back. How are things going?
Great. Nice to be back. It's been a great time. I've been working on a play out at Fourth Line Theatre in Millbrook, Ontario called Jim Watt's Girl Reporter, written by Beverly Cooper, directed by Kim Blackwell. And it's a story of Jean Watts, a young Canadian woman who goes to report on and participate in the Spanish Civil War. It's also about the rise of fascism in Europe just pre-World War II. Great for anybody who's interested in new plays or in Canadian history. It's a really great story and told by I think 25 plus actors, where there's a lot of us anyway. So if you're in the GTA area you want to come to Millbrook, Ontario, again, it's Fourth Line Theatre, Jim Watt's Girl Reporter.
Yeah, and so it's not just great because Lindsay says it's great. I got to see it last night with my wife, and we had a great time. The show was really good. Fourth Line Theater, it was our first time there, but the set was really, really great, and they made really good use of it. So I highly recommend it, and Lindsay was awesome as always.
Oh, thank you.
All right. So today I thought we would talk a little bit about what to do or what you need to know when the markets are crashing. And I know we've touched on this in the past. And by the time that this podcast airs, and probably a couple of weeks from our live recording date, things in the markets, I have no idea where they're going to be. But recently we've seen a couple of days, specifically one day that was the worst day for markets since 2022, I think. And all of a sudden we see all the talking heads coming out and making predictions on what it all means and what's going to happen next. And of course, as investors and as humans, we want to know what's happening. And typically we want someone to tell us how we should be reacting, how this changes things for us, and what we need to do to make sure we don't lose our life savings. So, I mean, some of the headlines I've been reading on LinkedIn and the news are things like, how markets are doomed and the bubble's bursting, to why value investing doesn't work anymore, or how there's nothing to worry about. It's just the buying opportunities. Don't panic. Basically, anything else that you can imagine. So, among all of these different posts of the last couple of days, two of them actually really stood out to me as something that I thought maybe, Lindsay, we could share with our listeners, because I think there's a lot of wisdom in that, which is hard to find, again, when there's a lot of noise going on in the media and online and all that kind of stuff. So these two posts are from actually a former guest on the podcast, Dr. Daniel Crosby. And Lindsay, I'm going to let you read the first post, which was a LinkedIn post.
Yeah. So the uncertainty of days like today can be a lot. Inevitably, there will be lots of prophets of peril who will rush in to try and tell you what's coming next in the market. What's more, you'll want to listen because something, anything, feels better than not knowing. But here's why you should be careful. David Draymond found that most Wall Street forecasts miss their targets by gaps so large they are practically unusable, either under or overshooting the actual number by more than 15%. Further analysis by Draymond revealed that from 1973 to 1993, nearly 80,000 estimates had just a 1 in 170 chance of being within 5% of the actual number. James Montier's Little Book of Behavioral Investing also highlights this difficulty, showing that between 2000 and 2008, analysts failed to even get the direction of the market right in 4 out of 9 years. The research is clear. Forecasts don't work, and neither does investing based on these forecasts. But here's the kicker. The worst forecasters are often the ones we are most likely to follow. Even worse, the more confident an expert, the worse their predictions tended to be, and the more famous the expert, the less accurate their forecasts. Today is a great day for sticking with the plan you built for your life at a time when cooler heads prevailed.
Yeah. So thanks for sharing that, Lindsay. So as you're listening to this, depending on where markets are, again, it's probably just feels like human nature that you want to listen, you want to know what's going on, you want to know what you should be doing. And despite us having multiple conversations every year with our clients about what the plan looks like, how we stick with it, regardless of what we hear in the market, excuse me, it's hard to not listen to this stuff. So I feel like this post from Dr. Daniel Crosby, even though the reasons we want to listen are all very emotional, but it does do a good job of kind of putting some real numbers to why we don't want to listen to the forecasters, right? Again, I know that money is very emotional, so sometimes it's hard to look at that. But usually, what we're saying is just no one can time the market, so stick with the plan. So I like this because it actually gave us some more specific numbers for people to look at. The other thing is, and maybe Lindsay, we could put a link to this in the show notes, but we can just look at the SPIVA scorecards. So we'll have a link to this in the show notes, but also if you just Google SPIVA scorecards, SPIVA scorecards in Google, and you click on it, and then you can go in and pick Canada, US, whatever you want to look at, and you'll see the percentage of actively managed funds that outperformed their benchmark for whatever time period going back to 10 or 15 years. So for example, right before the show, I just looked at as of the end of 2023 for Canadian equity funds over the past 10 years, only 3.37% of those Canadian equity funds outperformed the Toronto Stock Exchange. So, and to be clear, when I'm talking about funds, we're talking about funds that are trusted with trillions of dollars in investors' money and have hired really smart people and have a lot of money backing them from Bay Street, like all the big companies. So it's not like there's a lack of resources or these aren't smart people, but it's just, it's really hard for anyone to outguess or outsmart the market. And so whether that's deciding what stock to pick next or trying to figure out what direction the market's going to go and when to get in, when to get out, nobody can do it. And if anyone has done it in the past, it's just probably luck, and you don't want to count on it to happen again, right? Now, let's just go to the second post. I said there was two posts. So the second one talks a little bit about why it is human nature for us to want to be told by an expert what we should be doing. So Lindsay, if you want to go ahead and read that post.
Yeah, and this is paraphrased from Daniel Crosby's book, Laws of Wealth. So Ben Graham was onto something when he said, nearly everyone interested in common stocks wants to be told by someone else what he thinks the market is going to do. The demand being there, it must be supplied. This isn't just a case of misguided supply meeting demand. Our brains are hardwired to crave forecasts in a very specific way. Your brain, the most energy-consuming organ, accounts for only 2 to 3% of your body weight, but devours about 20% of your total calorie intake. The body, always seeking efficiency, tries to conserve energy, and nothing offers a bigger return on energy savings than slowing down the brain. And one way we can do this is by offloading decision-making to others. Studies show that listening to financial experts, say on television, actually shuts off some brain functions associated with critical thinking. While this cognitive respite might be efficient for bodily functioning, it's detrimental to making sound financial decisions. Simply put, when you start listening to some talking head, you stop thinking critically. Much like a cyclist drifting behind a competitor to conserve energy, our brains eagerly coast on the ideas of others, switching to energy saver mode. If you want to think less about your finances, and let's face it, we all do, be sure you are working with someone who knows you and your family specifically, your dreams, your plans, your comfort with risk, and not offloading your choices to someone you've never met. Again, paraphrased from Daniel Crosby's book, The Laws of Wealth.
Perfect. Thanks, Lindsay. So I'll admit that last line there makes it like a little bit biased, talking about, working with an advisor. But the point here is that there's a really, a very logical reason why we're so compelled to look for the answers from someone else. The most important thing here I want you to take away from this is to be sure you're listening to the right sources of information, right? So if you're making decisions based on commentary from talking heads, you need to learn to kind of tune out that noise and just focus on what you can control. Make sure you're getting your information from good sources. If your current advisor is coming to you when the markets are blowing up or suggesting that you should be changing your strategy or your allocation based on what's happening or what they see the markets doing in the future, it might feel good. It's probably what you want to hear, but you probably should run because, again, we know that nobody can forecast that. So if that's the kind of advice you're getting and the kind of actions that you're seeing, it means that basically you're being told what you want to hear, not necessarily what's going to help you, right? So I think that's really important.
So Joe, given all of that, and to wrap things up, what should our listeners focus on?
Sure. So great question, and something that, and I know we've talked about it in the past, but the first thing is when you're building your portfolio, you want to be doing it with your goals, your risk tolerance, your time horizon all in mind. That's the most important thing. You want to make sure the portfolio is diversified globally. So you want to consider the drivers of return based on the evidence. And this is all comes back to evidence-based planning, evidence-based investment philosophy that we've talked a lot about, right? You want to make sure you're rebalancing your portfolio and not doing it just when you feel like it because you're scared or you feel like you need to do something, but you want to have like a set schedule or set plan for when you're doing the rebalancing of your portfolio. That way you're taking the emotion out of it, right? And it's more rules-based rather than emotionally based. And that's not to say that you never revisit your strategy, right? So there are times where you're going to make changes to your plan or your strategy, but that's not again because things are scary or because of a prediction you heard or anything else like that. But maybe there's new evidence. So the academic research and investing has pushed forward and found some other areas of key drivers of returns, for example. So maybe we want to apply that to the portfolio or the strategy. But more commonly, what it's going to be is your situation has changed or your goals have changed. And those are the two main reasons why you want to go back and revisit your strategy and your portfolio. So again, I'm probably beating the same drum I'm always beating, but there's a reason for it, right? It's what works. So that's kind of what we want to stick with.
That's great. Any final parting thoughts? Anything you'd like to leave the listeners with outside of what we've just chatted about?
No, I mean, I think this was a pretty short and sweet episode.
Thank you for joining us for this latest episode of Your Retirement Planning Simplified. Be sure to tune back in for the next episode. And until then, we're here to help you simplify and succeed in your retirement planning.